Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourselves, Banking, and General Knowledge, etc. Today I will discuss about group discussion topics related to the internal promotion examinations for bank eligible employees. Welcome to part 19 of my Path to the Corner Office 2025-2026 series, where we break down real bank promotion exam questions and give you clear, practical sample answers throughout group discussions to help you climb the career ladder faster. Today's group discussion topic: strategic role of senior management in risk culture. Introduction. In the modern banking environment, risk is not an occasional event but a continuous reality. The global financial crisis, rising NPLs, cyber frauds, compliance failures, and rapid digitalization have highlighted that risk management is not merely a function of the risk department, rather it is deeply rooted in an organization's risk culture. This culture refers to the shared values, beliefs, attitudes, and behaviors that determine how risks are identified, assessed, managed, and reported across the bank. Senior management, including the CEO, executive directors, and top management committees, plays a strategic and decisive role in shaping, sustaining, and strengthening a healthy risk culture. Their leadership directly influences risk awareness, ethical conduct, decision making, and long term sustainability of banks. Understanding risk culture in banking. Risk culture goes beyond policies and manuals. It reflects how things are actually done. When dealing with risk, a strong risk culture ensures that employees at all levels understand the bank's risk appetite, take ownership of risks, escalate issues without fear, balance business growth with prudence. Weak risk culture, on the other hand, leads to excessive risk taking, window dressing, delayed reporting, regulatory penalties, and reputational damage. Why senior management's role is strategic? Senior management act as a bridge between the board's vision and operational execution. While the board sets overall risk appetite and governance framework, senior management ensures that these principles are embedded into daily banking operations. Their role is strategic because they influence behavior across the organization, allocate resources for risk management, integrate risk thinking with business strategy, act as role models for ethical and prudent conduct. Key strategic roles for senior management in this culture. Setting the tone at the top. The most critical contributions of senior management is tone at the top. Employees closely observe how leaders behave, especially during high pressure situations. If senior management prioritizes compliance, transparency, and ethical conduct, the same values cascade downwards. Key aspects include leading by example in following rules and procedures, zero tolerance for unethical practices, encouraging open discussions on risk. A strong tone at the top sends a clear message that risk management is everyone's responsibility, not just a regulatory formality. Translating risk appetite into action. The board defines the risk appetite framework, but senior management ensures its practical implementation. They convert abstract risk limits into operational guidelines for credit, market operational, and liquidity risks. Examples: aligning loan growth targets with sectoral exposure limits, ensuring treasury operations stay within market risk thresholds, balancing profitability with asset quality. This alignment ensures that growth is sustainable and not reckless. Integrating risks with business strategy. One of the major failures in banks occurs when business strategy and risk strategy operate in silos. Senior management must ensure that risk considerations are embedded in new product launches, digital initiatives, expansion into new geographies, large credit proposals, and consortium lending. Strategic decisions should be evaluated not only on returns but also on risk adjusted returns. This approach strengthens long term resilience. Strengthening governance and oversight. Senior management plays a pivotal role in strengthening governance through various committees such as Risk Management Committee, Asset Liability Management Committee, ALCO, Credit Committee, IT Strategy, and Cyber Security Committee. They ensure timely review of risk reports, early identification of stress signals, corrective actions before risks crystallize. Effective oversight reduces surprises and regulatory shocks. Promoting transparency and open communication. A healthy risk culture thrives on open communication. Senior management must encourage employees to report risks, errors, and near miss events without fear of retaliation. Strategic initiatives include robust whistleblower mechanisms, non-punitive approach to genuine mistakes, regular risk awareness meetings. This openness helps in the early detection of problems, especially in areas like fraud, operational lapses, and compliance breaches. Building risk competence and awareness. Senior management is responsible for ensuring that employees possess the necessary skills and knowledge to manage risk effectively. This involves regular training on credit appraisal, AML, cyber risk, and operational risk. Leadership development programs focusing on ethical decision making, sensitization on regulatory expectations, RBI, Basel norms, etc. A knowledgeable workforce strengthens the first line of defense. Aligning performance and incentives with risk over outcomes. One of the major causes of excessive risk taking is misaligned incentives. Senior management must ensure that performance evaluation and rewards consider quality of assets, not just volume of business, compliance and control effectiveness, long term outcomes rather than short term gains. This discourages aggressive targets that compromise prudence. Ensuring a strong risk infrastructure. Senior management must allocate adequate resources for advanced risk management systems, data analytics, and early warning signals, cybersecurity, and fraud monitoring tools. Investment in technology enhances risk identification and improves decision-making quality. Managing change and emerging risks. The banking landscape is evolving rapidly with fintech partnerships, AI, climate risk, and digital banking. Senior management must proactively address emerging risks by updating policies and frameworks, conducting stress testing and scenario analysis, engaging with regulators proactively. This forward-looking approach ensures preparedness rather than reaction. Regulatory compliance and supervisory confidence. Regulators increasingly assess risk culture as part of supervisory reviews. Senior management's commitment to compliance builds regulatory trust and reduces supervisory interventions. Consistent compliance culture protects the bank's reputation and ensures stability. Challenges faced by senior management. Despite best intentions, senior management faces several challenges. Pressure to achieve growth and profitability, resistance to cultural change at operational levels, legacy systems and processes, talent gaps in specialized risk areas. Addressing these challenges requires persistence, communication, and continuous monitoring. Conclusion. In conclusion, the strategic role of senior management in risk culture is central to the stability, sustainability, and credibility of banks. Policies, systems, and regulations alone cannot prevent failures unless supported by strong leadership and ethical behavior. Senior management acts as the custodian of risk culture, ensuring that risk awareness becomes an integral part of decision making at every level. For bank promotion exams and group discussions, this topic highlights leadership maturity, governance strength, and long term vision qualities expected from future senior executives. A strong risk culture, driven by committed senior management, ultimately transforms risk from a threat into a strategic advantage. Thank you very much for your patience. Request for like, subscribe, and share.